In the next 48 hours, the gold market is being forced to answer a question it always tries to dodge. Is the price you see the price of the metal or the price of a promise? Because while the screen can look calm to most people, the delivery plumbing is doing something very different. A single delivery cycle tied to COMEX 100 gold futures showed a total of 1,114 contracts lined up in the delivery ledger, with an intent date of February 6, 2026, and a delivery date of February 10th, 20. Those are not vibes, those are mechanics. And when mechanics get busy, it means someone is moving from talking about gold to demanding gold. That's where normal expectations break. Gold is supposed to be liquid. Gold is supposed to be the market you can enter and exit without friction. But friction is exactly what shows up first when supply is being tested. It doesn't start with a dramatic headline. It starts with the small numbers that only insiders watch. How many contracts stand for delivery, who is issuing and who is stopping, what it costs to source bars in a specific location, and whether premiums are tightening even when spot looks sleepy. And here's the time compression that matters. Not months, not weeks. In 48 hours. That's the window where delivery obligations get real, where funding lines are stress tested, and where a market can quietly reveal that the price on your phone is not the same as the cost of getting metal when you actually need it. They said this kind of split could never matter again, not in a world of instant settlement, deep liquidity, and global vault networks. Yet the structure keeps producing the same signal. Paper can trade smoothly while physical becomes selective. Institutions can see that shift first because they live inside the pipes. Everyone else sees it later after the story becomes obvious. What I'm about to lay out isn't opinion, it's pattern. It's the recurring sequence that appears when the gold market transitions from a chart to a contest over deliverability. Welcome to Vault Line, where we decode what matters before it becomes the headline everyone repeats. If you like analysis grounded in numbers and market structure, stay close. Think of subscribing the way you'd listen to that one wise elder who never raises their voice but always seems to know what's coming. And tell me in the comments where you're watching from, because the gold story looks different depending on which market you live in. Now let's reconstruct what's happening, step by step, the way the market itself experiences it. Start with the delivery ledger. In February 2026, the Issues and Stops report for COMEX 100 gold futures shows that 114 contracts were in the cycle for that delivery date, with the intent date stamped February 6th and the delivery date February 10. The roster of names in the report matters because it tells you who is actually touching the metal side of the system. You see the same cluster of major bullion banks and clearing members: HSBC, Standard Chartered, BNP Paribas, Morgan Stanley, JP Morgan, Barclays, and Citi. That's not a list you see when the market is purely retail sentiment and chart watching. That's a list you see when bullion flow is being managed by the institutions built to manage it. That's the first abnormality. Most people treat delivery as a footnote, but delivery is the point where a futures contract stops being a price exposure and starts becoming a settlement obligation. If you are short and you must deliver, you need the right kind of inventory and the operational capacity to move it through the system. If you are long and you stand for delivery, you need capital and margin capacity, and you need to survive any pressure tactics that might try to shake you out before settlement. At the same time, physical pricing signals are showing something that doesn't fully relax. $94. By itself, a few dollars of premium doesn't sound like a crisis. The meaning is in the persistence and the direction. Premiums tighten when immediacy is valued, when supply is not freely offered at the benchmark, or when demand is urgent enough that buyers pay to skip the line. Now add the third data point that creates a false sense of comfort: the vault totals. $467 trillion. That number is huge. It sounds like abundance. It sounds like a reason to dismiss any talk of tightness. But vault totals are not the same thing as deliverable float. A vault can be full while the market is tight, because much of what sits in vaults is owned, allocated, pledged, encumbered, or simply not for sale at the quoted benchmark. The market doesn't break because the planet runs out of gold. It tightens when the marginal bar, the bar that can actually move at the benchmark right now, becomes more expensive to source than the screen price implies. So you get a contradiction. Delivery activity is elevated, regional physical pricing holds a premium, and vault totals look stable. Over the next 24 to 72 hours, that contradiction is the story. Because contradictions are how markets confess. To understand why this matters, you have to see the hidden pattern. Gold doesn't move in a straight line. It moves through regimes, and the regime shift usually starts in the plumbing. Think back to 2008. The world watched credit seize up. There were moments when gold sold off alongside risk assets, not because the long-term case disappeared, but because liquidity became the only currency that mattered. Forced selling is not an argument, it's a mechanism. Then, as central banks expanded balance sheets and the world absorbed what had happened to the monetary anchor, Gold reasserted itself and moved into a new phase. First, the system demanded cash. Then, the system questioned the value of cash itself. In 2011, sovereign stress and policy uncertainty pushed gold into record territory for that era. It was the market expressing doubt about the durability of promises. Gold's role is not to be exciting. It's to be uncompromised. And when the system doubts compromises, gold gets repriced. In 2020, the pattern showed up in a way that was almost educational. Logistics were constrained. Refining capacity was disrupted. Transport bottlenecks mattered. The paper market could trade, but physical movement faced friction. Spreads widened. Premiums appeared. A dislocation emerged between future settlement and physical availability, and the resolution was not a polite convergence. It was a repricing of immediacy. Notice what those years share. Different causes, same structure. A moment arrives when the market stops being about a chart and becomes about settlement conditions. That is what a supply test looks like in the modern gold system. Now, in the current setup, the institutional movement is visible in the names and in the timing. The issues and stops report is not a rumor, it's a ledger. When HSBC, Standard Chartered, BNP Paribas, Morgan Stanley, JP Morgan, Barclays, and Citi are present in the delivery flow, you are looking at the entities most capable of sourcing metal, financing it, hedging it, and moving it across jurisdictions. Here's why that matters. These institutions sit at the intersection of paper and physical. They can be market makers in futures, custodians or participants in vault systems, and counterparties in unallocated accounts. They can provide liquidity when conditions are normal, and they can withdraw liquidity when conditions are tight. That doesn't require a conspiracy. It's simply how risk management works. When the cost of carrying positions rises, when funding becomes less predictable, or when settlement demand increases, the market makers adjust, and the adjustment can be subtle. It might show up as a change in willingness to quote tight spreads. It might show up as higher haircuts on collateral. It might show up as increased demand for specific bar sizes in specific locations. It might show up as more contracts standing for delivery because someone prefers settlement in metal over settlement in cash equivalents. This is the part no one is discussing when they only stare at the spot price. Now let's sharpen the dislocation, because this is where tension builds. 20, 43 with a premium, and the reality that premiums are an immediate measure of urgency. The two sides can drift for a while, but they can't drift forever. Either physical relaxes and premiums compress, or paper adjusts to reflect higher immediacy, or the system finds a third path through higher friction and tighter conditions. Think of it like an airline during a storm. The schedule might still show flights on time. The app might say everything is normal. But if one hub loses capacity, if one corridor gets congested, the real cost of a seat changes. The seat exists in theory. In practice, it becomes scarce at the quoted price. People pay more for certainty, or they accept delays. That's what a premium is in metal terms. It's the price of certainty. So what does premiums tighten actually mean? It means the market is charging more for now. It means there is a preference for immediacy. It means that the marginal buyer is willing to pay to secure metal rather than exposure. And when that happens at the same time delivery activity is elevated, it suggests that settlement preferences are shifting in a way that can matter quickly. Now, layer in the narrative contradiction that keeps confusing people. You can have respected research desks talking about gold at $5,000 per ounce by year-end 2026, with even higher levels discussed into 2027, while the near-term mechanics still look fragile and capable of forcing liquidation. That is not a conflict. It's a time horizon difference. The long arc can be bullish, while the short window is dominated by margin, positioning, funding, and delivery constraints. In other words, the system can punish you in the short run, even as it validates the thesis in the long run. That's why the plumbing matters. It's where the timeline gets decided. There is also a subtle clue inside the settlement reference itself. When you see a settlement figure on a delivery report, it reminds you that what's being exchanged is not a theoretical number, but a contract that must be closed in an approved way. In quiet periods, most contracts die before they reach this stage. They are offset, rolled, or netted. During stress, more contracts survive, to the point where someone must decide, close with cash, close with a hedge somewhere else, or close with metal. This is why the same institution names repeat. These banks are not simply trading direction. They are intermediating. They finance inventory, they warehouse risk, they hedge flows, and they smooth the mismatch between what producers sell, what manufacturers need, and what investors demand. When they are comfortable, the market feels deep. When they get cautious, the market feels thin, even if the chart looks unchanged. Caution can be triggered by small things. A tighter funding window, a shift in collateral policy, a rise in volatility that changes risk models, or a sudden surge in demand for a particular form of bar. Even when total gold is ample, form and location can create bottlenecks. A refinery can't convert large bars into smaller ones instantly. A logistics chain can't move metal across borders without time, paperwork, and cost. When the market needs conversion and movement at speed, premiums tend to speak first. That's the east versus west tension that keeps resurfacing. One side often trades gold primarily as a financial instrument, with deep derivatives markets and a focus on hedging and carry. And the other side often expresses gold demand as a settlement preference, where the bar itself matters. Those are broad strokes, but they explain why regional pricing can diverge. A premium is not only a price difference, it's a difference in what the market is asking the metal to do. History gives parallels through that lens. In 1971, the global monetary system changed and gold began repricing its role relative to paper claims. In 1980, after years of inflation pressure and stress, gold reached an era-defining peak, then spent years digesting the move as policy tightened. In the late 1990s and early 2000s, when gold was widely dismissed, shifts in reserve behavior and investor positioning helped lay the foundation for the next cycle. So when you see a near-term window where deliveries are active, premiums are stubborn, and the public narrative is relaxed, you are often seeing the early stage of friction. This is where the market decides what kind of gold market it is right now, a market of smooth exposure or a market of contested settlement. And when settlement becomes contested, the resolution usually arrives in one of three ways. Either fresh supply is coaxed out by a higher effective price, meaning premiums compress because sellers reappear, or the market changes the rules of participation, tightening margins, collateral terms, delivery incentives, or position limits, so fewer players can demand metal at the same time. Or the benchmark itself adjusts as liquidity migrates, and the real price becomes the one paid where delivery is valued. None of these outcomes requires the world to run out of gold. They only require the market to admit that certainty has a cost, and that cost can shift when participants reach for the door at once. Now we get to the evidence, the numbers that actually tell you what's happening instead of what people feel. Evidence point 1 is the delivery activity. 1,114 contracts tied to that February delivery cycle, with the intent date and delivery date stamped clearly. 94, 57%. Those numbers can sit together without drama on a spreadsheet, but they create drama inside a system that has to clear real obligations. When you put those together, you see a market that has plenty of gold in the system, but is still pricing immediacy differently depending on location and settlement path. That is a supply test, not scarcity, selectivity. Now let me show you the mechanism in plain terms without jargon. Most gold exposure in the world is paper exposure. Futures contracts, ETFs, swaps, unallocated accounts. Those are all promises, structured promises, but promises. Physical gold is the thing itself. A futures contract can be netted, it can be closed, it can be rolled, it can be cash settled indirectly through the market. Physical demands a bar. It demands a chain of custody, it demands vaulting, insurance, transport, and paperwork. It demands time. When markets are calm, paper and physical can stay close because the system's pipes have capacity. Market makers quote, tight spreads. Funding is cheap. Inventory is willing to move because the cost of moving it is manageable. In that environment, a premium is small and temporary. When markets tighten, the system tries to keep the headline price from jumping by using pressure valves. The first valve is margin. Increase margin requirements, and you force participants to post more collateral. That doesn't change the value of gold. It changes who can afford to hold exposure. The second valve is liquidity. When dealers widen spreads, the real cost of trading rises even if the last traded price looks stable. The third valve is inventory classification. All of those valves are ways to manage stress without rewriting the headline price immediately. That's why a market can feel tight to insiders while looking flat to everyone else. Now, why can't the gap persist? Because a premium is a magnet. If one region persistently pays more, metal is pulled toward that region unless something blocks the flow. Those blocks can be logistics, regulations, quotas, refinery constraints, or simply the reluctance of holders to part with metal at the benchmark. If the blocks remain, the premium can persist. If the blocks intensify, the premium can widen. If the blocks ease, the premium can compress. But when delivery demand and premiums both point in the same direction, the system is being asked to do more than it wants to do. It's being asked to deliver certainty. Over the next 24 to 72 hours, the market's behavior will tell you which path it's taking. If deliveries are met smoothly and premiums soften, the system is absorbing stress. If deliveries remain elevated and premiums refuse to relax, the system is signaling that immediacy is being repriced. If, on top of that, liquidity gets thinner and spreads widen, you're watching the dam hold back pressure by pushing costs into the plumbing. Now, forward analysis is not prophecy. It's simply a map of what this structure has historically led to. Scenario 1, the conservative path, the delivery cycle clears, premium tightness fades, and the market returns to normal functioning without a major repricing. In that case, the story ends quietly, but it still leaves a footprint. The footprint is usually higher friction. Dealers stay cautious. Liquidity remains selective. The market becomes more sensitive to the next shock. Scenario 2, the moderate path. The premium persists long enough that paper benchmarks have to acknowledge it. That can show up as a higher headline price, but it can also show up as curve shifts. Backwardation can appear. The front end can tighten. Delivery interest can remain elevated. In that case, the market is repricing immediacy in a controlled way. Scenario 3, the aggressive path. The system experiences a credibility moment where physical becomes meaningfully more expensive than paper exposure for a sustained period. That can happen without a collapse, simply through a re-rating of settlement certainty. In that environment, the market can move quickly because once trust becomes a variable, prices don't move in polite increments. So what do you watch to know which scenario is unfolding? You watch the delivery reports and whether totals stay elevated beyond what is typical for a cycle. You watch whether the same institutions remain dominant on both sides of the ledger, because that can signal internal reshuffling of exposure. You watch regional pricing signals like Shanghai premiums and whether they converge or diverge. You watch for signs that financing terms are tightening, even if you can't see them directly, by observing liquidity conditions and spread behavior. And you watch whether the calm feels manufactured, because manufactured calm usually has a cost. This is the divide, and it's the most important part of the episode. The divide is not between optimists and pessimists. It's between people who watch the headline and people who watch the plumbing. The headline is the last place stress appears. The plumbing is the first place it leaks. Institutions move first because they have to. They manage settlement risk. They manage funding risk. They manage inventory risk. Retail moves last because retail receives the story after it has already been translated into price. That's not a judgment. It's a structure. That structure is why an information gap becomes a wealth gap over time. Not because one group is smarter, but because one group is looking at the scoreboard the game is actually played on. Gold is not a mood. Gold is a settlement instrument. In the short run, the market tests it through delivery cycles, through premiums, through Volta, positioning, and through funding. In the long run, the market tests it through confidence in money itself. Different horizons, same metal. So as you watch the next 24 to 72 hours unfold, remember what the data is actually saying. Delivery mechanics are active and concentrated. Physical pricing signals are still charging for certainty. Vault totals are large, but availability is not the same thing as existence. If you only take one idea from this, let it be this. A vault can be full and the market can still tighten because the marginal bar decides the price. The market doesn't need to run out of gold to reprice gold. It only needs to reprice the willingness to deliver. This is Vault Line, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. The question isn't whether the gold market will keep testing its own plumbing. The question is whether you'll recognize the test while it's happening before the price has no choice but to reflect it.